Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze setups. Today, we're putting a specific company under the microscope, one that's been lighting up our screeners, LGCL Limited, ticker symbol LGCL. If you've ever wondered what it means when a stock becomes incredibly expensive to short, or how that can set the stage for explosive moves, you're in the right place. We're going to break down LGCL's current situation using real, actionable data. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/info card for LGCL. LGCL Limited, or LGCL, operates in the technology/software application sector. This Chinese-based company focuses on providing online agent-centric human capital management services based on a platform-as-a-service model. With a current market capitalization of approximately $55.06 million, it's a relatively small player in the vast tech landscape. Now let's look at its recent price action. LGCL has seen a tough period lately. Today, the stock is down -2.99%. Over the last 5 trading days, it's dropped -4.41%, and looking at the past 30 days, LGCL has shed a significant -38.10% of its value. This downward trend, combined with some other factors we'll discuss, is exactly why it landed on our hard-to-borrow screener. What is cost to borrow and why it matters? So, what exactly is cost to borrow, often abbreviated as CTB? Show animation of short seller paying FE. When a short seller wants to bet against a stock, it first needs to borrow shares from an existing owner. This isn't free. The cost to borrow is the annualized fee they pay for the privilege of holding those borrowed shares. Think of it like interest on a loan. A high CTB indicates that demand to short a particular stock is high, while the supply of shares available to borrow is low. And yes, these fees can absolutely exceed 100% annualized. Imagine paying nearly 700% interest per year on a loan. That's the kind of pressure short sellers face. It matters because it directly impacts the profitability of a short position. The higher the fee, the more conviction a short seller needs to maintain their position, and the quicker they might be forced to cover if the stock moves against them. Why this stock is hard to borrow right now. Show graphic, CTB 693.1%, CTB momentum plus 688%, shares available 10,000, foot 1.6 M. Now, let's connect this back to LGCL. This stock showed up on our hard-to-borrow screener with an astonishing annualized cost-to-borrow fee of 693.1%. That's not a typo. To put that in perspective, the average CTB for most stocks is typically in the low single digits. Even more critically, LGCL's CTB momentum has surged by a staggering plus 688 percentage points over just the last 5 trading days. This isn't just high, it's rapidly accelerating. Why? Because the supply of shares currently available to borrow for LGCL is incredibly scarce, only 10,000 shares at the time of this recording. Compare that to its estimated float of 1.6 million shares. When the demand to short vastly outstrips the available supply, the price to borrow skyrockets. Adding to this, LGCL's relative volume today 0x its 30-day average volume of 5,034,393 shares, with only 149,900 shares traded. Low volume on a stock with such high CTB can amplify price movements if short covering begins. Squeeze mechanics explained. Show animation of short seller buying back shares. So, what does this hard-to-borrow situation mean in terms of a potential short squeeze? A short squeeze occurs when the price of a stock moves up sharply, forcing short sellers to buy back shares to limit their losses. This buying to cover creates additional buying pressure, pushing the price even higher and triggering more short sellers to cover, in a cascading effect. With LGCL's cost to borrow at 693.1% and only 10,000 shares available, short sellers are paying a premium to stay short. If LGCL's price were to start climbing even modestly, that massive CTB fee combined with a dwindling supply of available shares could create immense pressure. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that LGCL's price will continue to fall, and they are willing to pay those exorbitant fees to maintain their position. Our internal composite squeeze score for LGCL currently stands at 50.4 out of 100, indicating a moderate but noteworthy setup. Dilution risk check. One critical factor to consider when evaluating any potential squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically lowers the price per share and can completely offset or negate a short squeeze thesis, even if the cost to borrow is sky high. More shares available means more supply for short sellers to cover with, or for new short positions to establish, alleviating pressure. For LGCL, we performed a diligent check and found no recent dilutive SEC filings like SMINUS1s, SMINUS3s, or 424BS in the last 90 days. This absence of recent dilution is a positive factor for potential squeeze scenario. Additionally, we found no recent reverse splits for LGCL in our look-back window, which can sometimes be a precursor to dilution or indicate financial distress. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For LGCL Limited, LGCL, if you're watching this situation, keep a close eye on a few key metrics. First, continue to monitor the cost to borrow rate and the number of shares available to borrow. Any further increase in CTB or a decrease in available shares could signal increased pressure. Second, watch for any significant increase in trading volume, especially on green days. A sudden surge in volume could indicate short covering or renewed buyer interest. Given LGCL's low relative volume today, even a return to its 30-day average volume of 5,034,393 shares could be a significant development. Third, keep an eye on price action itself. Look for technical levels of support or resistance that, if broken, could trigger further momentum. So there you have it, a deep dive into LGCL Limited, LGCL, and why its current hard-to-borrow status makes it an interesting educational case study. With an annualized cost to borrow of 693.1% and only 10,000 shares available to short, LGCL certainly stands out. However, remember that high fees don't guarantee a squeeze, and short sellers can maintain conviction. Always conduct your own thorough research. We aim to bring unique insights into these complex market dynamics. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments below what other stocks you'd like us to investigate. Thanks for watching, and happy learning.